Good morning. It's 8 a.m. on January 3rd, 2023. I'm Dryden Pence, and this is our So What video. 2022 was one of the worst years in stock market history. It was the worst year since 2008, one of the worst years we've had in 70 years. Why? This was in response to the tremendous amount of stimulus that went into the economy, that caused the inflation, that caused the Fed to react. I'm going to walk you through this a little bit, and we're going to see what's ahead for 2023. Obviously, our disclaimers are here. You have to take a look at them. Past performance is no guarantee of futures returns. I want to give you a little perspective. 2.5 years ago, we were looking at a market that was down 30% because the economy had stopped. Federal government regulations and activity had pretty much stopped in response to COVID. Then the next thing that happened, was we put a tremendous amount of stimulus into the market. More money went in 1 year than we spent in all of World War II. So you think about that. So we put $5.4 trillion into the economy right away. That caused inflation. That's caused the Fed to raise interest rates. That made the stock market go down. So you have to look at it this way. You had a 30% decline in the stock market because the economy was stopped and the economy was too bad. Then you had also a 30% decline in the stock market because the economy was too good. It's kind of which one do you want? We prefer the latter because on the latter you begin to see some good news. We're on the way to a recovery. So we think that 2023 is certainly going to be better than 2022. And history tells us that typically a year after an election and a year after a large drawdown in the market typically does better. There's some other good news. Right now we have something that we haven't had in almost 15 years. We've got a real positive interest rate. We have an opportunity for people to make some money in fixed income. That's important. This is kind of the unwinding of the new normal so that the next normal is kind of like the old normal. For years and years, during most people's economic adulthood, you've been able to get a positive interest rate significantly in the bond market. We're now returning to that. So for investors, it's an important thing to recognize. Fixed income is now your friend. Let's take a look at 2022. The four big things we talked about in every one of our videos was the invasion, inflation, interest rates, and the election. And we said the things to pay close attention to was when was there going to be peace, when were we going to hit a peak in inflation, when were we going to hit a pause in interest rates, and the patience we needed to have for the election. Well, here's what happened. Peace has not occurred yet. We still have challenges there. But we did hit headline, it looks like, of 9.1 on the inflation peak. Core was 6.6 in September, and it looks like we're headed into a pause, right? December was less than November. These are the conditions for improvement in the markets and stability in the economy. And then we had the patience that we had to have for the election. That occurred, and historically, we're up usually about 16% in the year after a midterm election. Roll forward to 2023. Let's look at it in a little detail. Again, we don't know about peace yet. But we did hit our headline, so we've certainly hit our peak. Pause being a complete pause, right? Not just a degradation of the increases, but it looks like that probably you've got a meeting coming up in February, another meeting coming up in March, and that will probably be the end of the tightening cycle. That's important because companies and consumers really can't work out their budgets and their capital spending plans till they know how much money costs, right? And interest rates is really just the cost of money. So it's important for us to recognize that we're going to have things a little rough until such time as we know what the long-term, what we know what these interest rates are, and the terminal rate in the Fed funds looks like it's around 5%. And then the thing we have to worry about is corporate profits. Well, right now, people don't quite know, and we won't know till we get past first quarter, what the effects of inflation have been and increased interest rates are on corporate profits. So there's a lot of data to come, which means we need to have some caution during the first quarter, but we think things get a little bit better in second and third. Let's talk briefly about the war. That's the big thing that's still an unknown, a catalyst for things getting better. Unless there's probably a offensive action by the Ukrainians in February or early March when the ground's hard enough for them to do that, we're probably not looking for any major big changes on the ground until in the summer. So you still have a number of months of the Ukrainian conflict that's going to continue to be an impactful factor in the world economy, in supply chains, and interest rates, and oil prices, and all of those things. So if we don't get a successful Ukrainian offensive in probably February sometime or March, then you're looking at later on in the summer. It's all about timing. Now let's talk about the things that are really, really important. Here's how this is all working. This is your peak inflation. This is headline inflation that we've seen. And you can see here, we peaked, right, in July at 9.1, and then we began to come down. This is all inflation, including increase of the money supply, increase all the stimulus, and the supply chain problems. So you're beginning to see this go down. Supply chains are improving worldwide, and we're beginning to see that. This is what we call personal consumption expenditures. Now this is kind of how you can really measure all the stimulus that went into the economy. So this inflation comes to, and we peaked around here about 6.8, right? Now core inflation peaks a little bit later, but this is, if think about this, is this covers all the supply issues, this covers just the demand issues. And again, you can see the trend is favorable, but there's a significant thing to understand here. That's the lag effects. You see, when interest rates go up, mortgage rates change really, really fast. Just like when, and they go down quickly, right? They adjust quickly. Just like what happens when oil prices go up, gas prices change really, really fast, right? And then they come down as oil prices come down. But those are really the two things that react quickly. Everything else is a little bit slower. Consumers and companies can't change their budgets or their spending habits quite as fast. So there's a lag, 4 to 6 months that takes place. So here's the important thing to watch. We began to see interest rates happening back here, in March and in May. Well, they didn't start showing up until several months later. This 4 or 5 month lag. So then you begin to see the big interest rates increase. They're just now showing up now. We haven't even seen the full effect of the last 200 basis point rise in the federal funds rate. So we're beginning to see this downward trend that we may see accelerate a little bit. It's important to note there are lag effects, and no one quite knows in this modern economy really how long they are. So you can see interest rates have gone up quite dramatically. We were almost at 0 at the beginning of the year. Now we're ending up north of 4, headed to 5. You're beginning to see the effect of all these interest rates have on prices. So the Fed's getting the result they want. But it's all a question of that great word, patience. How long is it going to take for all these changes to work through the economy? We now think that we may get another rise in February, maybe in March, of another 25 basis points to get to this target terminal rate that everybody's expecting, about 5%. Now, what's some good news here? Good news is inflation expectations have not increased dramatically. They're still fairly well anchored, and that's important because if the Fed sees that these are fairly well anchored and that inflation is not really taking off and that long-term expectations are becoming muted, they will move to a point where they pause. We hit this 5%, and that pause probably extends out throughout the rest of the year. That will be a situation that allows consumers and businesses to plan better. We can adapt tremendously. The U.S. economy is the most adaptive group of people in the world. All we need is some certainty around the cost of capital. Now, let's talk about the other big question on everybody's mind. What about recession? You can see in the past, when you have a rate hiking cycle, you hit a pause, right? And then after that, you get a recession, and then they lower rates, right? You've seen it a couple of times. We saw it here. Now, this recession was due to COVID, so it's a little bit of an anomaly. There wasn't enough time for all this to take place. Now, here we are back here. So the question in everybody's mind is about recession. Well, it's interesting. We're in this situation where we have some good news as well. And that is more people are working, making more money than ever before. More people are working, making more money than ever before. Indeed, real wages and salaries are near all-time highs. So the point of the matter is, it's awfully hard to have a bad recession when you've got more people having jobs than they've ever had before. As a matter of fact, we have more jobs than we have people looking. If you think about a normal type recession, they'd go, well, it's going to be horrible if we lose 4 million jobs. Well, the problem is here, we could lose 4 million jobs and it doesn't matter because there are 4 million jobs we're not able to fill. So the important thing to recognize is that this recession that we see coming may not be as bad as people think because fundamentals are still pretty darn strong. So what do we know? What's the so what? We know that the Federal Reserve stops hiking interest rates probably somewhere in the first quarter. The early part of the year, we reach the end of the hiking cycle. That's material for the economy, for the markets, and everything else. When we take that information, we have to look. There's one of two things that are going to happen, folks. You're either going to get a pause in interest rates where they keep it, they stop raising them and they just ride that out to the rest of the year to let the consumers and commerce kind of catch up with where they are, or they pivot. The pivot is where they start lowering interest rates. So for 2023, we actually think we're more in the pause area. And that means that we have no recession, right? Or a small recession, one of those shallow ones where you're kind of out of it, it's over before you know it happened, right? The other issue, the other debate is, do we have a pivot? And that's in the case we have a large recession. You know, that's the thing to pay close attention to, right? And if we pivot, if the Fed has to lower interest rates quickly in 2023, it's probably because they overdid it in 2022. As you look at 2023, what's the so what in all of this? Well, we think the first half of the year is going to be volatile as we get to that moment that we actually hit the pause, and it's kind of a grind, right? Companies that are making profits are going to do well. Earnings that are able to be stabilized in an inflationary environment are going to do pretty well. Companies can push through some price increases. The consumer holds up because there's a strong labor force, there's a strong employment situation, okay? And then the second half becomes more stable. This is that small recession scenario, right? 2024 we think is generally positive due to the high likelihood of cuts in the Fed funds rate. So in 2024 or late 2023, somewhere in there, you'll probably see that inflation's become under control and the Fed's in a position where they're changing their policy yet again and reducing federal funds rates and providing more liquidity into the market. So I hope that this has taken a few minutes to kind of give you, what does all this mean? Where are we right now? What do we look like for 2023? I want to remind you that historically, years after a really bad market tend to be positive. Years after an election tend to be positive. But I also want to say, you know, until the Fed hits this pause moment, sometime in first quarter, it's going to continue to be volatile and a little bit difficult. Thank you very much. I hope this clarifies a few things. We'll see you next time.